Hey guys, today we'll be talking about the book Financial Intelligence by Berman, Knigh, and John Case. So basically, what is an income statement sheet anyway? So as a financial professional trying to come to grips with your business financial records can feel overwhelming. Where do you begin? Well, learning to decipher like the income statement sheet is a great first step. Basically, it's a snapshot of a firm's key finances, summarizing its revenue, expenses, and profit or loss over a given time. And along with the balance sheet and cash flow statement, the statement offers vital insights into a company's overall financial health and performance. So next is crack the code on your income statement sheet. So start from the top. The first line is usually revenue or sales, which reflects like the total amount of money bought in the company from its products or services. Investors want to see a strong and steady revenue growth over time. And look at the gross profit. This is a revenue minus the cost directly associated with generating the revenues, such as material and labor costs, and examine operating expenses. These are the indirect expenses involved in running the business, such as research, marketing, administration, and staff salaries. Public companies are required to break down these expenses into like finer categories, and yeah. So next is consider operating income, also called as earnings before interest and taxes (EBIT). This is the amount left after deducting operating expenses from gross profit. And next is no interest and tax paid. Interest expenses are deducted to arrive at pre-tax income and stuff. Then income taxes are deducted to get like the net income or profit of the period. And check for non-recurring items like a one-time revenue like asset sale, or expenses like lawsuits will appear separately from core operations. And these non-recurring items should be noted when comparing profitability over time. And next is look for red flags: declining revenue, contracting margins, increasing costs at signal potential problems. Compare the numbers against historical trends and industry averages to spot underperformance and stuff. And yeah, and next is level up your analysis. So first off, take a fine-tooth comb, which is basically like referencing analysis and stuff, to your revenue records. There are accounting rules that determine when a company can record earned revenue or its income statement. These principles guide when revenue can be considered realizable and has genuinely been earned versus future revenue. Essentially, a company can't count revenue until a product or service is delivered to the customer. So next up is keep in mind that profit isn't a monolith. For an accurate read, look at the gross profit and operating profit, two important metrics found on the income statement. The key difference is that gross profits only accounts for direct variable costs, while operating profit also factors in fixed and overhead costs. Finally, don't forget the one big rule of reading income statement sheets. The number outlined in them aren't cold hard facts, but estimates and assumptions. The art of finance is basically learning how to generate and interpret like these assumptions and stuff. And yeah, that's about it. Yeah. Yeah, that's it for today. Comment, like, and subscribe, and bye, guys.